Okay, you guys are always, I always encourage you guys to ask questions as they come up. So I asked the class right before 8:30 if they had any questions. Not hearing any, I will continue rolling along. But if you guys do have a question, there's that either that blue raise your hand, or you can just, I'd prefer you just unmute yourself, or there's the chat room that hopefully Julie will be in to monitor shortly. Okay, I'm going to share my screen. And let's see. I always like to start off with the schedule. I was talking to one of your classmates before class started about how important it is. We were agreeing that it was really important to be organized and to keep a notebook of materials. Otherwise, it can kind of get overwhelming. So this is in the front of my notebook. It is our schedule. And you'll notice that today, we're scheduled to cover chapter 2 in one class session. And that's because I would say about 90% of the chapter is a review. You guys have had Accounting 100. You know all about the accounting cycle. You know that we need to journalize, then post, then create a trial balance and create financial statements. So I expect that today's lecture will be one of the easier ones we have. That will not be the case when we get into chapter 3. So the reason I'm pulling the schedule up is to let you know that we will be doing chapter 3 in class on Wednesday. And I think I saw that the video prep for chapter 3 is not due until next weekend. That's because I didn't want to give you 2 in 1 week. But if I were you, I would strongly encourage you guys to watch that video presentation before our next class. Even though I know it's officially not due until the 29th, I would encourage you to watch it before our next class, because chapter 3 out of these first 3 chapters is the one that I think is going to cause the most confusion. It's about a topic that we've touched in Accounting 100. It's about the adjustment process, but they're going to increase the level of difficulty quite a bit. So if you guys could preview that interactive presentation, that video prep, before you come into class, that'll make the lecture go much easier. I did want to also show you that we do have an exam coming up in a couple weeks, so make sure that's on your calendar. The exam will be available during the whole day. You'll have to pick a 2.5 hour time frame to take it, between 12:01 when it opens and 11:59 when it closes. So that's where we're headed. Any questions on the schedule? Okay, then the agenda. All that I'm showing you today is in your modules link here. The agenda is there, the Excel files are there, the handouts are there, everything's in that modules link. So I put the agenda in here again for 2 reasons: to keep me organized, but I think even more important is for you guys to take a look at it prior to the exam and kind of go through the checkoff list to make sure that you can do everything on there. So today we're going to talk about accounts, which we use in transactions. And you guys know all of these accounts except for maybe a couple new equity accounts. So I expect that to go fairly fast. You already know that here we use double entry accounting. It is something that goes back to the days of Christopher Columbus. Louis Pacioli is what we call the father of accounting. And we know that at a minimum, every transaction that we record includes 2 accounts. That's where that double entry accounting comes from. And there's always this check and balance feature. It came to pass in the Christopher Columbus days that they needed a way to account for all the merchant ships that were coming in and out of the so-called New World. And so if you're not familiar with that, go read a little bit about it in your book. You guys should be really good at rules of debits and credits because we've been practicing them for a whole semester in Accounting 100. Again, I would focus on the new accounts, the equity accounts, because some of those may be new. You already know how to journalize, so we'll practice that. Remember that the journal is the first place a transaction gets recorded. The journal keeps a great economic diary of what's happened, but the downfall is there are no balances in it. And so we learned that we have to post to the general ledger, and you guys have all had practice with that. We'll do, I think, one exercise where we refresh your memory on that. We know that anytime after we post, there's lots of debits and credits flying back and forth. And so the trial balance, the sole purpose of the trial balance is to show that the sum of the debits equals the sum of the credits, going back to that double entry accounting feature. Today, we're also going to recap the financial statements, and you'll see on the agenda, I want you focused on the new one. We've done an income statement. What replaced the statement of owner's equity is the statement of retained earnings. So that's new. So I want you to focus on that. And then we'll practice the financial statement. So that's kind of where we're headed today. I am not a big PowerPoint fan, but because this chapter is mostly a review, I thought the PowerPoint would be a good way to review the chapter. So let me stop for a second. Does anybody have any questions? Again, options for questions: unmute, raise your hand, the little raise your blue hand, or type in the chat room if you're not able to talk. I know some people look at this at work and they don't want to speak because there's other things going on around them. Sometimes they're in cubicles. So you guys also have that chat room that Julie will help me monitor. Okay, then I'm going to pull up the PowerPoints. You guys all have PowerPoints in the modules link. I'm not going through all of them, so I've gone through and deleted a bunch. So if you want to look at these later, you can. But I did want to pull up the kind of the accounting cycle of how we are mentally going through these transactions. So in Accounting 100, I know this because I'm doing this with my Accounting 100 class right now. We learn to identify transactions. We need to know what a transaction is. And we said a transaction is an event that affects the financial resources of a firm. And we learned in Accounting 100 how to analyze. And we put the accounting equation up, and we said that every single transaction has an effect on the accounting equation. And then we learned to record relevant transactions in a journal. So remember that journal is like an economic diary. In Accounting 100, we talk about sometimes a teenager keeps a diary of what happens to them as the days go on, so they can go back and look a year later. The journal is the same thing, but it's an economic diary. We can go back, and if we wanted to find out what happened economically to a company last January, we could go pull out their journal and look and see what happened. But the journal didn't have the totals, and so we learned that we had to post things from the journal to the ledger. We called that process posting. And then last semester, we learned that the trial balance was that document that led to the creation of the financial statements. So we already know about accounts. So again, these are all available for you guys to look at in the modules link. I'm just going through them very fast as a way to review the topic before we jump in and get our hands dirty. We'll be doing an exercise where we identify asset accounts today. Take a look at those. If there's any that look foreign to you or you're not quite sure about, write those down. There's usually two that cause students a little bit of issue. Prepaids are one. Prepaids are assets. Those are things that we pay for ahead of time. The example I would use is a gym membership, right? Sometimes you can get steeply discounted gym memberships if you go buy a year pass at Costco, let's say. Well, that has value to it. So we first set it up in the prepaid, and later in chapter 3, you'll learn how to adjust that. And then this is an account that you guys had right towards the end of chapter 100, notes receivable. And that's a formal written promise to pay, an IOU. So an IOU has two parties to it. The one that the money is owed to, that's notes receivable. And then the one that owes the money, the debtor, that would be notes payable. That would come up in the liability section. So we've learned about all these asset accounts previously. Let me stop and see if there's any of those accounts up there that you're not quite sure what they mean. Okay, then liability accounts. There's definitely one up here that causes students problems, and it's this unearned. So I'm going to put a star next to that. Most liability accounts can be identified with the word payable. So we know what accounts payable is. That note payable I just defined for you, that's the formal written promise, but this time it's from the debtor standpoint. Accrued liabilities are all those payables that you guys talked about in the payroll chapters last semester. They all have the word payable in it, like Social Security payable, Medicare payable, federal income tax payable, all those. Those are accrued liabilities. That is the focus of chapter 3. But this unearned always throws students off. And the reason it throws students off is the word payable is not in it. That's one reason. The second reason, unearned revenue, people automatically assume that's a revenue account and they misclassify it. And I taught an Excel class over the summer, and out of all the accounts that we talked about, that one was miscategorized the most often. And Excel students typically have 2 or 3 accounting classes behind them. So unearned revenue is money that we receive in advance. So think about that gym membership that we just talked about. If I bought that directly from LA Fitness, happens to be the gym that I go to. When LA Fitness gets our money, that is an unearned revenue because they've received money ahead of when they've earned it. And so they recognize it in this weird liability account called unearned revenue. And then in chapter 3, you'll learn how to recognize the revenue as the time, in the case of a gym membership, as the time is used up, the amount would be recognized. Another example of that, I know we have a lot of sports fans in here from looking at the discussion post. Another example of that would be like season tickets that you buy to one of your sports teams. So let's say, I think the Rams are back in town. So if I want to buy season tickets or partial season tickets for the Rams, that would be a prepaid to me because I'm prepaying for it ahead of time. But when the Rams get my money for the preseason tickets or the season tickets, that is an unearned revenue to them. That would be recorded as a liability initially, and then every time the Rams play a game, they would recognize that portion of the revenue that has been earned. That's chapter 3. The ones that I really want you guys to focus on in the reading and when you're doing your outlines are these equity accounts, because the equity accounts have changed. Before, we had capital and we had drawing, and that's now been replaced by common stock and dividends. Dividends is the equivalent of a drawing for a corporation. Last semester in Accounting 100, when the owner invested, that's usually a key word, invested, when the owner invested money into the firm, they use capital. Now, because we're using a corporate entity, when owners invest money into the corporation, in exchange for that, they're given common stock. And when a corporation decides that they want to share profits with their owners, now we use dividends instead of drawing. Okay, the other things that cause the equity umbrella to go up and down are revenues and expenses. You already know about those two. So here's that expanded equity equation that we have to have a good understanding of in this chapter. And again, this is the new part. The equity umbrella has changed a little bit. And what's not on here is another account called retained earnings. And that's because we really haven't started a corporation yet where we would have retained earnings. That's coming later today. Questions on those first 7 slides that I showed you? Okay, we know that everyone, oops, let me go back to that, has a chart of accounts. You'll notice the same numbering system that you saw in Accounting 100, almost the same numbering system. All the assets are given account numbers in the hundreds. All the liabilities are in the 200s. The equities are still in the 300s. The revenues are still in the 400s. These expenses now can be in the 500s and 600s. 500s are usually related to merchandising and cost of goods sold. You'll see that come back in another chapter. And the 600s are more of the general and administrative and selling expenses. So that's a little bit of a change. In Accounting 100, I think we only went through the 500 series. We know there's still rules of debits and credits. In Accounting 100, there were 5 rules of debits and credits. Debit just means left. Credit just means right. You guys have a whole handout in the modules link that kind of refreshes those rules of debits and credits. Still to this day, when I take exams in my accounting classes, I still write out that accounting equation expanded with the debit and credit pictures. That still helps me to this day. So it would look something like this. And of course, the equity umbrella has to be expanded. I'm going to skip through a couple of these. Here's an example of a journal entry. I want you guys to understand that we're using Connect in the class, and Connect cannot use descriptions because they have no way, the computer has no way to see if it's right. So one thing I want to point out to you, because we're keeping an economic diary for the company, we need to get in the habit of writing descriptions down. And these descriptions would include any kind of source documents, which was also a term that they used in the chapter. That means if we used any check numbers or confirmation numbers, if you're paying online, or there's any kind of invoice numbers that we need to leave a good audit trail, we would include those in the third line descriptions. The reason I'm bringing that up is because when you guys do your Connect homework, they don't ask you for a third line description. And the reason they don't ask you for that is because the computer has no way to check it, right? So on that first example, the mirror might say owner's initial investment. The book says received investment by owner. I might write startup investment by owner. All those are right. There isn't one right answer. So Connect doesn't ask you for that. Those of you that are considering accounting for a major, you got to leave a good audit trail. You still have to know that all transactions need a good description. And again, this keeps a great economic diary, but the problem is there are no totals. And so we learned about ledger accounts. Ledger accounts are almost like big T accounts, which you'll see me use today, with a cumulative balance going forward. And this PR means post reference. That tells you where the transaction came from. It looks like in this example, they all came from the general journal, page 1. Last semester, you may have seen that as J1 for just journal, page 1. When all that posting's done, we do a trial balance. A trial balance is a verification that the debits and credits equal. Well, you all came up from Accounting 100. I was about to say those of you that came from Accounting 100, but you all have had Accounting 100. You know that that trial balance was the starting point to that worksheet, and we already know how to do that. So here's an example of what a trial balance might look like. We ensure at the bottom that the debits equal the credits. This would be the starting point for our worksheet. If a company doesn't use a worksheet, it would be the starting point for our financial statements. And then I hope we've all had the experience of not being able to balance, right? We do that trial balance and we find out that, oh my gosh, my debits don't equal my credits. So searching for errors is important. If you're not sure about how to find your error, this would be a really good screen, a really good slide to go look at before you take the test. I believe there might be one multiple choice question about errors. So I'll let you guys read that. Then come the financial statements. You'll see them in the middle. We do an income statement, a statement of retained earnings, and a balance sheet. Statement of cash flows, we're skipping over because we have a whole chapter on that coming, the very last chapter that we do. Let's see. Financial statements. I want the focus to be on the new statement. So we'll be doing a set of these today. I believe you guys have a 10-point test question where it's going to ask you to create, if it's not this set of financial statements, it'll be a statement of retained earnings. So we know that if we're looking at a trial balance, let me go back to that trial balance. The trial balance, every single account on here has to wind up on a financial statement. So in Accounting 100, I kind of tell my students to work from the bottom up. Okay, in other words, if I start at the bottom, here's my income statement accounts. Remember that an income statement records revenues and expenses. And that net income is carried over to the statement of owner's equity. Now it's called a statement of retained earnings. Remember, every number on a trial balance has to wind up on a financial statement, every single number. So once we get our trial balance done, we kind of work our way up from the bottom. We get our income statement that shows whether the company was profitable or not. We carry that profitability over to the statement of retained earnings. And then the last thing we do is we make sure on the balance sheet that our assets equal our liabilities plus equity. The ending number on the statement of retained earnings is carried over to the balance sheet. So last semester, you saw one account in the equity section on the balance sheet. It was called capital. This year, and we'll do one of these, you're going to see two numbers in the equity section of a balance sheet. I hope you guys write that down because this is a change from last year. In the equity section of a balance sheet for a corporate entity, you're going to see at least two accounts: common stock, which is what the owner invested, and the retained earnings that you get when you compute this statement of retained earnings. So that's something new. Let me go back to that financial statements. The statement of cash flows, we won't worry about because we have a whole chapter on it. And then come the demonstration of the three statements. So there's the income statement. Couple things I want to point out. In Accounting 100, your author didn't think it was important to mess around with dollar signs. You guys weren't responsible for putting dollar signs on your work. But in accounting, when we are preparing documents to be shared with external users, okay, not the journal that we keep inside and the ledger that we keep inside, but when we're creating documents that will be shared, and if you have a corporation, chances are you probably have some shareholders who will be expecting these financial statements. You put dollar signs on the first line in each column and also on the last line. So you might want to jot down just some presentation specifics. I think I'd probably call it presentation issues. Dollar signs go on the first line in each column and always at the bottom, and this would be for each statement. So details on the left, totals on the right. Let's see, what else can I say about that income statement? The third line has to define the period of time, right? And I noticed this in my Excel class. A lot of students struggled with getting that third line right. When I get an income statement and that third line is not there, some people just mistakenly put December 31st. I asked myself, is this for a month? Is this for a quarter? Is this for a year? That's a pretty important thing to know. So the who, what, when still carries over from Accounting 100. We got to watch the little details now. We got to watch where the single and double underlines go. Let me stop there. Any questions so far on anything we covered, or especially on that income statement? And Julie,
Professor,
go ahead, Tamir.
So the trial balance is a point in time. It's not a period in time, right?
Yes, the trial balance is an internal document that's usually not shared, and it's usually prepared as at a specific point in time.
Okay, so does it need a 3-point heading or no?
Yes, it still should have. What you don't care about on that are the dollar signs.
Okay.
It's staying inside. Let's go back and look at that trial balance real quick, just to make sure we're on the same page. So there's that trial balance. It was created as of December 31st. That was the cutoff point. Now, an external user, this would not go in the hands of the external user, because an external user wouldn't know, is that for a quarter, for a year? So this is just for us to make sure that the debits equal the credits before we do the financial statements. And I'm glad Tamir asked that question, because financial statements, let me go back to the income statement, they never have debits and credits. You'll never see a financial statement that has the columns of debits and credits. That's because external users don't know what they are. They haven't had accounting classes. They just want to know, hey, what's the results of operations? And that's what these financial statements are deemed to tell them. But you would be surprised. I would say, again, using the Excel class, because that's one of the more advanced classes, I would say 20% of the students still were putting debits and credits at the top of the columns. We don't have debits and credits on financial statements. Here's the new one, and this is the one I want you guys to pay attention. I'm going to make it a little bit bigger so we can hone in. The reason we do that income statement first is because just like last year, it carries down to the next statement. So that profit carries down to this new statement. I'm going to put a highlight on this one because it is new. This is the one that you're most likely to see me ask you about on the test. So this is a brand new company. How do I know it's a brand new company? They had 0 in retained earnings. They haven't made a profit yet to retain. Remember that the word retain means to keep in. Like people retain water. This is, you have 2 things that can happen to your earnings. You can either retain them, keep them out, or keep them in, I should say, or you could distribute them to the shareholders in the terms of dividends. So this statement looks a lot like the statement of owner's equity, but the difference is we're not looking at capital anymore. We're looking at retained earnings at the beginning of the period and at the end of the period. Net income makes it go up. Dividends make it go down. If there is a loss, which a lot of businesses are experiencing right now, if there is a loss, you would see 2 deductions. You would see less net loss and less dividends. Any questions on that new statement? That's one of the things I want you to write down in your notes. Study that statement of retained earnings because it's new. Okay, then the last statement that we'll worry about is the balance sheet. It's still, just like last semester, is proof that the accounting equation is in balance. It is the only one out of the 3 that is at a specific point in time. In my accounting 100, I always take a snapshot, like a picture. This is a snapshot as of one specific point in time. And as I mentioned to you earlier, my cash might be this amount tomorrow or today, but tomorrow, if I go buy a Starbucks, here I go with my addiction status. If I go buy a Starbucks today, my cash is going to change tomorrow. And then presentation issues, let me go back to normal size. You don't have to worry about dollar signs internally. You don't have to use them in journals and ledgers. Dollar signs do go on financial statements, and trial balances are optional. It's up to you whether you want to put them or not. And the dollar signs go on the first and last numbers in a column. And then the last thing in this chapter that's new, because I don't recall covering this in Accounting 100, is the debt ratio. This is a really important ratio. This tells you what percentage of the assets have an interest by the creditors, right? And the debt ratio and equity ratio always have to equal 100%. Okay, what the heck does that mean? We're going to calculate one. But if I come up with a debt ratio, I'm pulling this number out of the air, of 60%, when I compute that, if I come up with a debt ratio of 60%, that means all of my assets either have an interest by my creditors, okay, in this case, 60% of my assets, my creditors have an interest in it. The offset of that is always the equity ratio. That means if my creditors have a 60% interest in my asset, that means me as the owner, I have 40% interest. They're always the opposite. They both have to add up to 100%. So this is new. We will practice this. I believe our last exercise today is going to be on that debt ratio. I don't think you have this in Accounting 100. So it's another thing that I want you to write down in your notes to focus on. So again, where's the new stuff? The equity accounts are new. I would focus on retained earnings, common stock, and dividends. I would definitely make sure I could prepare a set of financial statements, especially that new one, the statement of retained earnings. And for most chapters, these ratios are going to be new. In this case, the debt ratio is new. It helps evaluate the level of debt risk. What the heck does that mean? It means that the more debt I have, the more riskier my company becomes. Okay, why? Because just like you guys, my debt needs to be paid back. My equity ratio on the flip side, if I have a 60% debt ratio, that means I have a 40% equity ratio. I don't have an obligation, a legal obligation to pay my shareholders every year. I don't have to do that. I can choose to share dividends or not. And so the higher this debt ratio is, the more risky, or leveraged is another word that we use. I don't think your book used this word. The more leveraged a company is said to be. So let me stop. That's kind of an overview of the chapter. 90% of it is a review. The new stuff are the equity accounts and that ratio. So let me stop and get questions. And I think we're just going to jump in and get our hands dirty and practice as much as we can fit in.
I have a question, Professor.
Sure.
If you do have a higher debt ratio, but let's say that your liability turnover is like really good, does that kind of balance out the kind of like the risk, the liability like the company like has?
Well, if that were the case, the debt ratio would go down. If it stays at 60%, that just means that you're replacing old debt with new debt. Or another word you might hear, because I know you're interested in the field, is you're just churning your debt. You're just turning it over, but it still comes. Like I pay my car payment, but it still comes every month. It still comes. Now, hopefully my balance goes down a little bit, but anytime there's a high level of debt, that scares off investors because our creditors get paid off before our equity holders get paid off, right? In other words, when let's think of a company that declared bankruptcy lately, Sears. Let's use Sears as an example. When Sears liquidates, the debt holders come way up here and they get paid before any of the shareholders get paid. So that's where that becomes a risk. It's a good question, as always. Any other questions? All right, let's jump in and get our hands dirty. So you guys are going to go to the modules link. Remember, everything I'm showing you is in the modules link. I'll show you where. You'll scroll down to chapter 2. Okay, right here are the Excel files. Whoops, that's 3. Right here are the Excel files for chapter 2. You can click on those. You'll see a little arrow to download them. Now, I've already downloaded mine, so you can download yours if you need to. In the future, start opening those before class starts to save us time. And you'll probably get a message at the top that says something like enable editing. You'll want to click on that so that you guys can type into these if you prefer to work on the Excel files in class. The other option is you can just take notes manually. And don't forget that Julie is posting these in the discussions room. So if you can't quite keep up, or I know that some of you have told me you would rather listen and watch than worry about having to write things down, Julie is posting these. I think I posted it last time, but let me show you where. In the discussions area right here, class contributions from lecture, here's the one that I posted. It's the completed solutions that we did in class. I hesitate, honestly, to post those because I don't want you becoming lazy. And what I mean by that is I don't want you to just blow through the lecture, not work out anything with us and just go download that solution. Because then what happens is you look at it and you go, oh yeah, I can do that. Oh yeah, I can do that. And you don't physically make that hand to brain connection. But I've still continued to post those for those of you that may need a little extra time in working out the solution, or maybe you can't keep up with me sometimes on Excel. That's there for you to fall back on. So any questions on the files or downloading, or anyone in the room that is not sure where these files are, because I will wait until you find them. Just speak up. Okay, so I probably, well, it looks like I kept the directions pretty same. What I always do, I always expect my students to know 3 things about every new account. So depending on what the directions asked, I just went down here and kind of created my own directions. I want you to know 3 things about every account, and I will ask you multiple choice questions on the test. I want you to know the account type, what the normal balance is, and which financial statement it falls on. So I'm going to do the first couple of these together, and then we're going to try the last ones, and you guys can check your work. So land is an asset. So I'm going to put in asset, or you can just put A for asset. Because it's an asset, assets have a normal debit balance. And because it's an asset, it goes on the balance sheet. Now I'm going to center these so they're a little bit easier for you guys to see. If you're not sure how to center stuff in Excel, you might want to watch with me. So I'm going to highlight this gray area. I'm clicking up here, left clicking, and I'm going to put those as being centered so they show up a little bit nicer. So I'm going to do it one more time. I'm going to highlight the gray areas going across, and right here under the alignment tab, there is a center button. I'm going to click that, and now they're right in the middle. I think that's a little bit easier for you to see. All right, so cash, we know that's an asset. We know that it has a debit balance, and because it's an asset, it's a balance sheet account. So I'm going to wait. I'm going to quietly wait for you guys to try these. And then while you're trying them, I'm going to try them. What I'd like you to do right now is look away from the screen or work on your screen, and then we'll come back in a few minutes and we'll check the answer. Okay, so go ahead and try the remaining one. I highlighted one that's heavily missed just so you're focused on that. I'm going to be quiet, and then we'll come back and we'll do this together. Check yours against mine, especially letter G. because that's where the error usually happens on multiple choice questions. And let me know if there's any of those that cause you any grief, anything you need explained. Okay, so expect a couple of multiple choice questions that ask you questions like that. For example, a question might say, which of the following accounts are liability accounts? And it'll list them. And you'll have to pick which of the one, or it might say which of the following is not a liability account, and it will list accounts and you'll have to pick. It might say which of the following accounts do not have a credit balance, and it'll list 4 accounts and you'll have to pick out the one that doesn't have the credit balance. Okay, again, almost all of that is a review. I think everything on here is a review. I don't see any new accounts. What I'm going to put up here is I know what the new accounts are. So the book didn't ask you this in this question, but I'm going to put them up here. I'm going to put the 3 new accounts: common stock. I'm going to write in retained earnings. And I'm going to put in dividends. Those are 3 new accounts that I guarantee you will see questions about. So I'm going to put those down there. I'm going to go and try and freeze these headings up here. So if you guys would like to freeze them with me, I'm going to come up here to probably cell D20, because this is where I want the freeze to happen. I want that black line to remain put. So if you're in Excel, you can go to the view and you can freeze the panes. I want that black line to stay up there, so when I scroll down, I can still see what it is I'm typing in. So I just froze my panes. How do I do it again? In case you missed it, go to D22, go to view, and go to freeze panes. That'll keep it from spinning when we move down. All right, so these are all equity accounts. So account type, these are all equity accounts. The reason that they're new is because we have changed from a sole proprietor in Accounting 100 to a corporate type of entity in this class. So common stock is a regular equity account. It has a credit. Retained earnings is a regular equity account. It has a credit. And dividends throws people off. It's like drawing. It is a contra equity. And so it has the opposite balance, a debit balance. And here's the part where people struggle. So I'm going to go put that in yellow for you to bring attention that this is where I know where the mistakes are going to be made. Which financial statement do these go on? Okay, common stock is one of the 2 equity accounts that are going to show up on the balance sheet. And here's the trick one. Do you remember last semester how capital showed up on 2 financial statements? It was what we call a bridge account. Well, retained earnings is also going to show up on 2 financial statements. And I'm going to put asterisks because this is the one people miss. It shows up in 2 places. It shows up on the statement of retained earnings, and it also gets transferred over to the balance sheet. So it's going to show up in 2 places, kind of like capital did. Capital showed up on the statement of owner's equity and it got transferred to the balance sheet. And then dividends shows up on the statement of retained earnings, kind of like the drawing account showed up on the statement of owner's equity. Now we're in a corporate entity. We don't have drawing anymore. It went away. It was replaced by dividends. And dividends will always, always, always be a subtraction on the statement of retained earnings. Just like drawing always pulled the capital account down, dividends always pulls retained earnings down. And we have a whole chapter, one of the hardest chapters we'll work on this semester. We have a whole chapter on equity accounts, specifically retained earnings and dividends coming up. It's our second to the last chapter, it's going to be the chapter that blows us out of the water. That's why it's so imperative, so important that you do really well on this first test, because it is a review for the most part, and build up those test points and build up that insurance policy that we create for ourselves. When we do really well in the beginning on the review stuff, it takes stress off us near the end where we do the harder chapters. And I've already mentioned in here that the last 3 chapters are the most difficult. Any questions on those new accounts? Okay, not hearing any questions. Let's go over to 2-7. Now, these are all accounts. I've made T accounts to make the analysis easier for us. These are accounts that we've been working with in Accounting 100, but in Accounting 100, very rarely did we make you work backwards. In Accounting 101, the level of critical thinking skills goes way up. So we're going to read through these 3 exercises, and in all 3 of these cases, they're going to ask us to compute something that's missing. And so I choose to use T accounts on most of the things where I'm trying to figure out things that are missing. So that's how I'm going to show this to you. I made 3 T accounts. We're going to fill in the information. We'll fill in what we know, and then we'll try and solve for the unknown. So letter A says Quarantine Company had 152,000 on September 30th. And it looks like they're asking us about October. So that would be the beginning balance. So I'm going to put in BB here for beginning balance. And what they told me is that at the end of last month, we had 152,000 of accounts payable. And we had 132,500 on October 31st. Okay, that's my ending balance. I'm going to go put that in 132,500. That's my ending balance. Okay, let's think about how accounts payable work. I'm going to write in the rule for liabilities. It looks like that. What makes accounts payable go up are purchases. So I'm going to write that in. And what makes accounts payable go down are payments. So that's what the accounts payable T account looks like. You start off with the beginning balance. When you buy things on account, it adds to it. And when you pay your debt on account, it makes it go down. And when everything's said and done, they told us that our ending balance was 132,500. That's our ending balance. So let's fill in what they gave us then in letter A. It says total purchases on a credit. Okay, that's here, was 281,000. And determine how much cash was paid. They're asking us for this yellow line. They're asking us to figure out how much must have been paid on account. Okay, so there's lots of ways you can do this. Formula nerds will put an X in there and calculate it formula-wise. I'm not a formula nerd. I tend not to be. So what I'm going to do is I'm going to put a little subtotal in here. I'm going to make it red so it stands out. And what I'm going to do is I'm going to foot the first part of this account. So when I do that, when I add those 2 numbers up, either on my calculator or in Excel, I got 433,000 and I have left 132,500. That means that I must have paid the difference between these 2. So I'm going to go in and fill that in, 433,000 minus 132,500. You guys double check me. I got 300,500 must have been the payments on account. Okay, so how did I solve that? I remembered what accounts payable looks like. I know that it is a liability account. And like all liability accounts, it goes up with credits and down with debits. I knew what I started and ended with, and they gave me my purchases. So I added this up. I knew that I had to get down to 132,500, so I subtracted those 2. That's how we got the 300,500, right? All we did in Accounting 100 is we knew that accounts payable were credited for increases and debited for decreases, and we might have made a journal entry here and there. We even footed T accounts, but they never made us work backwards. So that's, again, critical thinking skills turned up. It's like university level class. And so we need to crank up our level of practice on some of these. All right, questions on A. B, then. Now he moves to accounts receivable. It says on September 30th, okay, accounts receivable is an asset. It's going to look like this. So it says on September 30th, that was the end of last month. They started off with 102,500. It says during October, the company collected. Okay, how does accounts receivable work? It goes up when we make sales on account, and it goes down when we make collections on account. That's what the accounts receivable account is used for. Up when we make sales on account, that means people owe us money, and down when we make collections on account because the amount they owe us decreases. So let's fill in what we know. During October, the company collected, that would go over here, 102,890. The October 31st balance was 89,000. Let me go down here to the bottom. 89, oops, wrong side. 89,000 was my ending balance. All assets will have a debit balance. That's where I know, that's how I know that that is a debit. And so here they're asking us, how much is that? Okay, well, again, you could put an X in there and you could do a formula item, or you could go backwards. What do I mean by going backwards? Do this, add those together, and then subtract that out. Okay, either way will work. For those of you that are formula nerds, let me put in how you would maybe solve this if that were an X, and then you work whichever way works best for you. If I was footing this with my calculator, here's what I would do. I would take 102,500 plus X minus the amount paid. This is how I would foot my account, equals 89,000 if you're a formula nerd. Okay, how do you solve that? Well, probably the easiest thing to do would be to simplify these two numbers. So I'm going to simplify that. I am not a formula nerd, but for those of you that are, I'm trying my best to show you two ways to do this so you can pick whatever works for you. Let's see, 102,500 minus 102,890. Somebody check me. I got X minus 390 equals 89,000. The way that I would fix that algebraically, if you're a formula nerd, you'd add 390 to both sides. And that means you're left with 89,390. I'm trying to demonstrate it a number of ways so that you can take your choice. If you're not a formula nerd and you know how to go backwards on this, you would add these two that I just showed you here, and then subtract out that beginning balance, and you would get exactly the same thing. Okay, that's critical thinking, working backwards. Questions on accounts receivable on A or B? Okay, let's go take a look at the cash account. Okay, before I even read it, what does my cash account look like? It's an asset, so it's also going to look like accounts receivable. I'm going to have a beginning balance. I'm going to have an ending balance. And then this comes from your own cash accounts. You're going to add in cash received. So I'm going to add in cash collected. Put a space bar before you use that plus. And I'm going to take out cash out. I'm going to read from letter C, and I'll fill in the blanks as I go. And hopefully they'll give me enough information where I can fill out what's missing. So letter C over here says during October, they had 102,500. Okay, that would go right here, cash in. And they had 103,150 of cash disbursements. The October 31st balance was 18,600. So this time they gave me the ending balance. I'll put that in red since that's our ending balance. What they wanted you to figure out on this one was how much must you have started the year with? Okay, well, again, go ahead and do this however you want, whether you are a formula nerd and you want to put X in there and solve for X, or you can take the difference between these two and kind of work backwards. If you were footing this and you were a formula nerd, you would just write down with that missing X how you would foot this. If I were footing this on my calculator, I would take that beginning balance, which we don't know, add in my cash receipts, take out my cash disbursements, and that would give me my ending balance. So that's how I would foot this on my calculator. So once again, I'm going to solve for the left-hand side. You guys check me. This is what I got. X minus 650 equals 18,600. And when I added the 650 to both sides, I'm left with X equals, and I'll let you guys get a minute to figure that out. In my head, it's 19,250. That must be how much the beginning cash was. So this author is going to challenge you. Not only is he going to make you record transactions like you did in Accounting 100, he's also going to test your ability to critically think backwards, forwards, sometimes sideways. Questions on that? No questions. Okay. So that's an example of critical thinking. The next one is on journal entries, and I'm going to pass at the top of mine. I put, instead of demonstrating this problem, we're going to go to 2-3B, which also uses journal entries, right? You guys are pros at journal entries by now. You've been recording journal entries for a whole semester. So in the interest of time, I'm going to skip the next two, and we'll do something similar on 2-3B. So I'm going to skip 2-8. I'm going to skip 213 and 214, which are T accounts. I put that in there for anybody that wanted extra practice, but I'm going to move over to 2-3B, where we're going to be doing all of that, right? So 2-3B kind of summarizes what the previous two problems attempted to do. So make sure you're all with me. We're on problem 2-3B. It's about 5 tabs over. And we will journalize to make sure that you guys remember how to journalize. Some of us, it's been over the summer and we're a little rusty. And then rather than using general ledgers to post, we're going to use these T accounts down here to post. And I think I may have even written the formulas in so that a trial balance will be created by itself. And if not, we may have to go back and foot a few of these if the formulas aren't spot on. All right, so let's see, on your test, there probably will be some type of a 10-point test question. I don't know if it's journal entries or T accounts, but they're the same thing. The journal entries is what we use to record the economic diary. The ledger is what the account balances will be. You should be able to do both. When the test gets closer, and I'm actually going to create a new one. So as the test gets closer, I'll make sure by this weekend you guys have a test review sheet to start looking ahead on once I create that test. I think I have that on my calendar to do on Wednesday. All right, so we're gonna do the journal entries and then I will post at least the first 3. And I'll send you in a file the completed problem. So I wanna make sure that we know how to do it. We'll do at least the first, I don't know, 3, 4 transactions. And maybe we'll go see if any of these are new and we'll go do the new ones. And then I wanna move on to the financial statements because I know for a fact there's gonna be a 10-point test question on financial statements. All right, so the owner invested, keyword. When you see invested for a corporation, you will be using the common stock account. So they invested 30,000 cash along with equipment in exchange for the common stock. Okay, journal entries, we have to date it. To keep Excel from turning this into a weird formula, press the space bar first and then type in the November 1st. Okay, and then what happened with that one, they invested 30,000 cash. We know that we have to list our debits first. They also invested office equipment. And because of that word invested, they got common stock in return. Okay, so let me go put my amounts in. 30,000 of cash, 15,000 of office equipment was placed into the firm by the owners. And in exchange for that, these owners got back common stock. So let me wait for a second. Make sure you're good with that. We're going to go post these in a minute. Just giving you guys a minute to ask questions and to get caught up. In the meantime, making sure that they don't throw me any kind of curveballs on these. Give me one more minute. I'm going to go down and post those as we go. You guys are very practiced in posting and journal entries. I don't anticipate this to be a problem for anybody as long as you did well in Accounting 100. So let's go post those. We're going to post them down below here. So cash is going to be debited for 30,000. So I'm going to come down here to my cash account, put in that 30,000. I will date all these. I'm going to make this bigger so you guys can see the date. Cash went up. I'll go find the equipment account that also went up. November 1st. 15,000. I believe I put formulas in here to foot the accounts for you so we didn't have to mess with that. So if you missed it, let me go show you again. Cash was debited for 30,000. Equipment was debited for 15,000. And we're going to credit common stock for the whole thing. Common stock is a new account for you. So be careful that you know how that one works. I always put debits and credit rules directly on the accounts. So you know what I would have done if this were a test question for me, even before I started it, I would have gone and written the rules of debits and credits through pictures. In other words, all my assets look like this. Everything else on the other side of the account, liabilities, equity, dividends, because it has that minus sign, is the opposite. And then revenues, minus plus, and expenses are plus minus. I'm going to make those revenues a little bit wider so you can see them. And if I did my job right, my trial balance should be always accumulating. So if we were to do a trial balance right now, you would see your debits equal your credits. Okay, we're going to do a couple of these. Here's why I assign this problem. I want to make sure that you remember how to do journal entries. I want you to remember that that journal creates an economic diary for the company. Okay, November 2nd, we're going to do the second one. Says the company prepaid 4,500 cash for 6 months of rent. They want you to debit the prepaid for the whole amount. Chapter 3 will work on the adjustments. For right now, they just want you to initially record the transaction. Okay, and they give you that big hint. Debit prepaid rent. Let me look at the date. That was November 2nd. space bar so Excel doesn't throw you into a formula loop. The prepaid account went up and the cash went down. You should put a brief third line description on these. I skipped that first one. Maybe I'll go back in and put that in. Initial owner investment. And then you would skip lines normally. I won't worry about that right now. This one would be 6 months of rent. Let me get those amounts in. 4,500. You guys also have these questions in your ebook. I just tried to put them into an Excel spreadsheet so that we could create a nice, neat place to do our work. And I wouldn't be flipping back and forth, driving you guys crazy between the ebook and the Excel spreadsheet. So I'm going to go post these. This is 2 asset accounts. Here's a question on the test. I remember a lot of people missing it. Here's the question. Just given that one transaction that you see me highlight there, just given that one transaction, here's the question I remember throwing people off. What would the effect on total assets be after the transaction on November 2nd? Okay, I'm going to say it again. What would the effect on total assets be after the November 2nd transaction? Anybody want to give it a shot? It's okay to be wrong.
No effect.
No effect. That's right. Total assets would be the same before and after because this is a swap of assets. They gave up cash and they got a prepaid back. There would be no change in total assets. Whatever total assets were before that transaction would be the same as total assets after that transaction. And if you're unsure, you could go test this. Right now, if I were to ask you, before I post that, if I were to ask you, what are total assets? Let me go down to my trial balance here. Total assets right now are 45,000. You guys see that? Let's go post that transaction and let's see what total assets are after that. I'm telling you it's going to be 45,000. Let's go test that. So let's go post that transaction we just did on these T accounts. The prepaid rent went up by 4,500. That would be here. Let me put that date in, November 2nd. And the cash went down by 4,500. 4,500, November 2nd. Now let's go see. Go add up our total assets now. When I do that on the calculator, 20,500 plus 4,500 plus 15,000, do you see how it's 45,000 again? Our total assets were 45,000 before that transaction, and they're 45,000 after that transaction. Why? Because all that transaction did is switched out the cash for another asset. We gave up cash, we got a prepaid. So I'm trying to give you guys hints on what to expect. The critical level of skill thinking has increased in this class. In Accounting 100, we wanted you to just know the journal entry and post it. We didn't ask you deeper level questions like that. Let's do one more. Let's do, unless you guys see another one that you also want to work out, I'll definitely take those questions in a minute. Let's do at least one more. The company made credit purchases. Okay, that just tells me that I went into debt. Credit purchases of office equipment and supplies for 600. The payments due within 10 days. Okay, so let me date this. First thing we do with journal entries is we date them. I'm going to hit the space bar, not to throw Excel into a date loop. I purchased office equipment and office supplies, and it was on account. That would be accounts payable. My debt went up and my assets went up. So 2,500 on the equipment, 600 on the office supplies, 3,100 on the debt. Brief description would include any kind of document numbers. I don't think they gave us any. To record purchases of assets on account. I'm going to put the term net 10, which means it's due in 10 days. Questions on those first 3 transactions on the journalizing process or how we would post transactions? Let's go take a look at these transactions in a minute. Let me give you a second to catch up there. And then let's go scroll down and see if we see any new ones that we might need a little bit more direction on. Okay, let's go scroll down here. Let's see, completed work for client and immediately received cash. That's pretty straightforward. We did a prepaid. I think the only new one I see for you guys is on the 28th, where they paid a cash dividend. Remember, if you guys will remember that dividends is replacing the drawing account. Instead of debiting drawing on that one, you would debit that new account dividends. So you would debit the dividends and you would credit the cash. I think that's the only one that might throw you for a loop. So what's going to happen is Julie was going to post her file where we only have the first 3 done. And then I'll come behind Julie and I'll post 2-3B. I'll post it as, I'll put the answer in there. So you guys at least have a full and complete answer in case any of those give you problems on the homework. Questions on that? Or do you see anything else that you want to go over on that question? All right. Then 2-7B, this is a 10-point test question. I'm sure that I asked you guys to do a set of financial statements. To be honest with you, I haven't decided if it's going to be a full set like this one or just a statement of retained earnings. But even if I don't ask you to do the other 2, it will be asked of you in a multiple choice question. So it'd be nice if they gave us a trial balance, but he just gave us all the accounts. The nice thing is it looks like he put them in chart of accounts order, right? He could have given them to us alphabetically and made us hunt for where's the revenues and expenses. So he kind of gave this to us in a nice order. And then he asked us to do 3 financial statements. Okay, what I'm going to do in the interest of time and holding your attention, I'm going to do the statement of retained earnings because that would be the one that I will definitely ask you to do. And it's also the new one. So what is a statement of retained earnings? It shows us how the company's retained earnings has changed from the start of the year till the end of the year. Now, here's the question that always comes up on the homework. This company started on July 1st, and this data is on July 31st. That means they're brand new. Their first month is July. And so their beginning retained earnings is 0. That's implied. Okay, by reading this, this is their first month. So beginning retained earnings is 0. They don't have any retained earnings because they haven't yet started business. So when I do a statement of retained earnings, it's going to look very similar to the statement of owner's equity. I'm going to write out what that shell is going to look like, and then we'll go fill it in. So when I give you a test question, the first thing I'm going to be looking for is, do you know how to head up that financial statement? So I'm going to scroll down, and what I did, so I wouldn't have to make your heads bobble back and forth, right before class started, I snipped this and I just brought it down. If you guys have a snipping app, you can do that. So I just brought it down here. What I'm going to do is the who, what, when for the statement of retained earnings. So here's what this is going to look like. I'll worry about centering this when I'm done with it. So the who on this is the name of the company, which I think they told us was Presec. The what on this is a statement of retained earnings. By the way, some companies will call this a returned earnings statement. Either one is acceptable. And then because this is replacing the statement of owner's equity, just like the statement of owner's equity had to define the time period, so does this one. So they mentioned that this was for the month ended July 31st, whatever year. Now I'll center that in a second. I'm more interested, rather than the look of how this is going to look, I'm more interested in how you set this up. So in this chapter, here's how they have you setting this up. They have you showing retained earnings on July 1st, which is going to be 0. They're going to add net income. They're going to subtotal it up. And they're going to take out the dividends. And that's going to give us our ending retained earnings on July 31st. Okay. No debits and credits on any financial statements. I want to make that loud and clear. They've put all this in one column. It's not the way that I would have created it. I would have had 2 columns, but I think because they're just starting you out, they're going to have you do 1 column. They assume that you guys have not had Accounting 100, by the way. So I'm going to center this over the statement so it doesn't drive us all crazy. So the way you center in Excel, you can do it with me. Highlight the area you want to center it over. And then on this alignment tab here, this is the alignment ribbon. There's this little, I call it an exploder. There's probably a better name for it, but I'm going to explode it. And what you want to do is center across the selection. I'll do it one more time in case you missed it. And that will put it right smack dab in the middle. Okay, so if you missed it, one more time, just so you know how to do this in Excel, highlight the area you want to center it over. Go to the alignment ribbon or tab. Use the little exploder at the bottom right-hand corner. And then right here at the top where it talks about horizontal alignment, not center, that's what a lot of people choose, but center across selection. That'll put it right smack dab in the middle. Most importantly though, can you fill it in properly? Well, we just said retained earnings is 0. So I'm going to put that 0 in there. Net income, I got to compute that. Net income is the difference between the revenues and the expenses. So I have 2 revenues here. This would have been done on the income statement, which we're choosing to shortcut in the interest of time. So it looks like my revenues, just chicken scratching that out, my revenues are 37,500. And my expenses, I'm going to come over here and I'm going to highlight those 4 expenses. You can do this on your calculator or you can do it on Excel. I'll give you guys a chance to add those 4 expenses up. 15, 16, 8, I think in my head. And so if my revenues are 37,500 and my expenses are 16,800, go ahead and do that on your calculator. I have a calculator in front of me. I got net income of 20,700. Okay, off to the side, just for presentation purposes. That equals revenues. You wouldn't write this down on the statement. This is just for demonstration. Revenues of 37,500 less expenses of 16,800. That's how we came up with 20,700. Okay, I would subtotal this. They didn't have any beginning retained earnings, but your Connect site will still subtotal this 20,700. The dividends, the money that the company paid out to its owners was 6,000. Let me write that in. By the way, financial statements generally have no minuses on them, no subtractions, unless there's a loss or possibly to show a contra account. Your author does not put subtractions around dividends. So let me go ahead and do the math. Here's our subtotal, 20,700 less 6,000. Let me let the computer do that so I don't mess it up. 14,700. That would be the ending retained earnings statement. Okay, is there anything new on the balance sheet? Okay, there is. When you do the equity section of the balance sheet, I'm going to pull it over on here. Julie, I'm hoping you can take a picture of it maybe. When you do the balance sheet, you want to focus on the equity section. There will be 2 equity accounts now. Last semester you had 1, you had capital only. This semester on the balance sheet in the equity section, there's going to be 2 accounts. Common stock, which is the money that the owner put in, 34,800, and that retained earnings, that's going to show up in the equity section. So I'm going to take a shot, and if anyone's in the room and can do the screenshot to share with your students, awesome. Let me show you the balance sheet. I'm going to pull it over here. The thing I want you to take a look at, hopefully I can pull it over here from my other computer. The thing I want you to take a look at is right here. That equity section would have 2 things, 2 items now. The common stock, which is the invested equity. Okay, it's not going to let me do that off. This is the invested equity and the earned equity. This is invested and this is earned. 2 different types of equity. Invested equity is what the owners put in. Earned equity is that retained earnings. It's what the company has generated from its profits. Where did that retained earnings come from? From the statement we just did. So in a nutshell, you guys need to be able to do all 3 financial statements. They will carry us through from the start to the end of class. We know how to do an income statement. It looks identical to what we did last semester. The statement of retained earnings is the new one. That's the one I want you to focus on. That's the one we focused on in this problem. And then the balance sheet, I want you to pay attention to the equity section because it's new. In 100, we had 1 account called capital. In this class, 101, because we're talking about a corporate entity now, there's 2 types of equity. There is invested, I would write that word down, invested equity and earned equity. So one of the things I want you to write down, can you do a set of financial statements without looking at your notes? How do you test that? If you can do this homework problem and you can create a full set of 3 financial statements, you're good to go for the test. The other account I'll point out that a lot of people miss is that liability. It does not have the word payable on it. So a lot of people miss that. Unearned revenue is a liability account. It's money received ahead of when it's earned. You did have it in Accounting 100, but it was right in the last chapter or 2 when you guys were tired and working really hard just to take that last exam. Questions on anything you've seen so far?
Yes, Professor. I just had a question regarding the income statement.
Okay.
Just to be clear. So because we're doing a corporation, it's going to be single step, correct?
That's a good question. No, Thamir, it's single step here because right now we are beginning with, it looks like a consulting firm. So the reason it's single step, it is single step, but the reason it's single step is because this is for just an entity that doesn't do any merchandising or doesn't do manufacturing. It's just a service firm. And so because of that, this is single step. But when we get to merchandising operations, I think it's chapter 4, you're going to see that multi-step statement that you learned in Accounting 100 come back.
Okay. So
Yeah.
for the test, it's going to be single step.
Yes, because the first 3 chapters deal with service entities for the most part. Yes.
Okay, good to know. Thank you so much.
You are welcome. Things I want you to pay particular attention to: dollar signs on the first line in each column on all of these statements, and single underline when there's a math operation taking place, and double underlines on the bottom. So this is a completed income statement. The retained earnings one we did in class. This one might be a little bit neater. And then the balance sheet, I want you to focus on that equity section, 2 accounts. Common stock, which is invested equity, and then retained earnings is earned equity. Why am I making a big deal about invested equity and earned equity? Invested equity came from the owners, right? Eventually, you need to give that back to them if the company liquidates. They fall in last place, by the way. So if you've ever wondered why some people are a little hesitant to invest in stocks, is because they have seen big companies like Sears, who used to be a behemoth when I was younger, right? If you had a Sears card, you were something, because they were located everywhere. You could walk in and pretty much get anything you wanted. Occasionally, these large companies, Sears, what happened with Sears, they didn't adapt quick enough to the internet sales. And so Amazon came along and you didn't have to go into a Sears anymore. You could pretty much find what you like and you could buy it online. So there is a risk as an investor when you invest in stocks. You can lose money. You can only lose up to how much you have invested in the company. So earned equity is safer. They've earned that on their own, and hopefully they'll use that earned equity to either what Amazon's doing right now, expanding. It seems like literally every couple of weeks we hear of a new company that they've purchased. Or they could be, once Amazon gets established, my guess is at some point they'll start sharing dividends with their owners. Last I checked, Amazon hadn't paid dividends. I could be wrong on that, but last time I checked, they had not. Questions? Don't forget the purpose of that balance sheet. Always, the reason we do a balance sheet last is to show the user that the assets on the left side of the fundamental accounting equation are equal to the liabilities and the equity. Okay, right now, while I have this balance sheet up here, because I know that this next thing is new, right now I want to calculate the debt ratio for this company. So I know we haven't talked about that yet, but since I have this up, let's go ahead and talk about the debt ratio. Here's what I want to know. We're looking at a balance sheet. What portion of these assets here do the creditors have an interest in? And the offset, whatever we get for the debt ratio, is going to be the equity ratio. What percentage of the assets do the owners have a claim to? So the debt ratio, we saw it on a slide, is total debt on top, divided by assets on the bottom. Another way of saying debt is liabilities. Okay, so I'm winging this. It's just something that I know has thrown students off, so I'm going to get some extra practice in on this. The total debt on this one is $12,000. The total assets on this one is $61,500. I got my calculator out. You guys should all have a calculator out. 12,000 divided by 61,500. If I round, it's about 20%. What the heck does that mean? My assets, creditors have a 20% interest in. By default, the equity is the offset. It's the rest of it. It's the other 80%. They always have to add to 100. So if your debt ratio is 20%, your equity ratio is 80. If I told you the debt ratio was 30, you would tell me, well, the equity is 70. They have to balance out to 100. The higher that debt ratio is, the riskier the company typically is seen to be, because debtors get paid back first before shareholders. In a liquidation, the creditors of the company are way up here on the debt liquidation list, and the shareholders are dead last. Questions on that? Okay, then let's go to exercise 2-24. I'm glad this problem's in here because I got a lot of emails this weekend, which is a good thing, not a bad thing. This weekend, I got a lot of questions. I think it was on question 6, I want to say. And it was manipulation of equity. Again, my focus in here for you guys are equity transactions because that's the new part. So I'm glad that this question came back because it kind of goes along the same line as that. So we're going to work through one more of these. I thought we needed it after the last chapter, I should say. So again, these make us think. These are not easy questions. They scramble our brain sometimes when we're thinking about these. So we can use this thing that I set up, or we can visually do this. I'm fine either way. Here's what I know. I know that at all times, my accounting equation has to be in balance. So I always go back and I write this at the top of my paper. Always, even today when I take advanced courses. It says the company had the following assets and liability at the beginning and end of the year. Okay, before I even read through these, here's how my brain works. I know that assets equals liabilities plus equity. So right off the bat, before I do anything else, I'm going to get these two parts to balance. In other words, at the beginning of the year, if my assets were 60 and my liabilities were 20, I know that my beginning equity has to be 40. Because assets plus liabilities equals liabilities plus equity. 20 plus 40 equals 60. So I haven't even read the question yet. I just fill these in as I go. I always go back to that fundamental accounting equation. So here's my beginning equity. My ending equity is going to be the difference between these two again, right? Because my assets have to equal my liabilities plus equity. So when I take the difference between those two on my calculator, 105 minus 36, I get ending equity of 69. So again, I haven't read this. I know that my starting equity is 40. I know that my ending equity is 69. That means that in all of these situations, the change to equity, there's my Greek delta sign, it's a triangle, it means change. My change to equity is the difference between these two. My change to equity in all of these circumstances is $29,000. The difference between the ending equity and the beginning equity. I can tell you right now that equity went up by $29,000. I don't know yet what curveball they're going to throw at us, but my first step was just visually looking at this and filling in what I know even before I read the rest of this question. My beginning equity is 40, the difference between 60 and 20. My ending equity is 69, the difference between 105 and 36. And looking at those two numbers, I can tell that my change to equity was 29,000. Okay, now remember, changes to equity are caused by three things. So before I read this, I'm just going to go down to A. I know what my beginning and ending equity was. Okay, I know that my beginning was 40 and my ending was 69. That was caused by one or a combination of three things. Additional investments on all of these, add net income, and take out the dividends. Those are the three things that cause equity changes. So since I know that these three things have to equal 29,000, there's my change in equity. Let's go read letters A, B, C, and D and see what happened for in these circumstances for me to come up with 29,000. Okay, letter A says the owner made 0 investments. Okay, so this is 0. Let me come out to equity and move this over. They made 0 investments. I'm looking at letter A, and no dividends were paid. Okay, well, if my, 0. If my change to equity was solely comprised of net income, then my net income must be $29,000. So net income is equal to 29,000. Why? We figured out the change in equity at the get-go. We know that equity changes were caused by 3 things, and we had 0 additional investments and 0 dividends. That means all of that 29,000 was caused by net income. Okay, letter B. We're still looking at the change of 29,000. We don't have to fill all that other stuff in because we have our equity changes to deal with. We still know that the change in equity is 29,000, and we still know that 3 things caused those changes to happen. Now I'm going to go up to letter B, and I'm going to fill in what I know and figure out anything that I don't know. So letter B tells me the owner made no investments and dividends were 15,000. Okay, the owner made 0 here, and dividends, I'm going to put a minus on it so you understand that it would be subtracted out. And so their question is, how much must net income have been under those circumstances? Okay, well, we know that these items, when they changed, were 29,000. So what must have net income been? Let's see. If net income, be careful on this one. If net income, some people put 29,000, and that would not be correct. X, I'm going to do a formula and then we'll talk about going backwards. X is net income. Here's what I know. If I do this, if I'm a nerdy formula person, no disrespect to those of you that are, I am not. X minus 15,000 equals 29,000. There's our formula. The way that you would solve that is you would add 15,000 to each side, and you would be left with X being $44,000. Okay, the other way to look at it, if you're not a formula nerd, go backwards. 29,000 plus 15,000 is how we get X. X is 44,000. X equals 44,000. Let me get rid of that X for right now. X equals 44,000. So chapter 2 had a very similar question that threw some of us for a loop. I probably answered, I don't know, 8 to 10 emails this weekend on that question. I'm glad it came back so we could get a little bit more practice. Okay, letter C. Again, the same 3 things cause changes. So I'm going to copy these down so I don't have to rewrite them. And I know that just like the first 2, my change was 29,000. So let's go read letter C and fill in what we know. Letter C said no dividends were paid, but the owner did invest an additional 55,000. Okay, 55,000 came in. There were dividends paid. Let me go read that again to make sure. No dividends were paid. So let me go put my 0 here. So again, they asked the question, what is net income? Okay, well, I have to get from 55,000 down to 29,000. What must have happened? They must have had a net loss, right? Because the owner put 55,000 in, but the total equity change was only 29. Another way, again, if you are a formula nerd, another way you could say this, 55,000 plus X equals 29,000. Okay, how do we solve for that? I got to get X by itself minus 55,000 on each side. And what you're left with is what our answer is, 29,000 minus 55,000. I think I cut off a 0 here. The answer has to be that net loss was 26, a negative 26. So net loss, I'm going to capitalize it, is 26,000. Because that's the only thing that makes that add up to a change of 29. Questions on the first three, on A, B, or C? Okay, last one. I'm assuming they're going to ask me the same thing. I'm going to write down those 3 changes that caused that to happen. I know that just like the first 3, the change to equity that I showed you at the beginning is still 29,000. That's the constant that remains between. Let me go read it. D says dividends were 15,000 and the owner put in 35,000. Okay, dividends were 15 and 35,000 was put in. So 35,000, 15. They're still asking me for the net income. You could do this with nerdy formulas, or you can just visually look at it. Here's what I see, because I'm not a formula person. When I net these, I get 20,000 and I got to get to 29,000, right? So the sum of these are 20,000. I got to get to 29,000. That means my net income has to be 9,000. That's the only thing that makes that formula work. If you like formulas, here's what you're going to write down. 35,000 plus X minus 15,000 equals 29,000. And you're going to work backwards through that. Questions, because that out of everything I gave you in chapter 1, it's probably because we did a lot of demonstrating on the other things. A question like this was the one I got the most emails on this weekend. I did a couple of Zooms with people that were struggling with that one. All right, expect some type of a 10-point test question where I have you filling in missing components. Our last one is probably that debt ratio, I'm thinking. Oh, no, it isn't. Shocked I didn't give you guys a debt ratio. Could have swore I did. I'm glad we worked on one. Here's another one of the same. It gives you a bunch of different items and it asks you for missing pieces. It looks like in this case, they're using broadcasting companies is what this looks like to me. Changes in equity accounts. So it's more of the same. What I would focus on again are changes in equity. So let me do 1 or 2 of these so you have an idea. CBS started with 0. There's 3 things that cause changes in equity. I'm going to list them in the same order that I've been listing them, even though I know your author has switched it up on this. But I like to always get one formula in my head that I can use every single time. And so when I'm looking at this, I'm thinking of just equity changes in the order that they occur, which is usually owner investments, and then either net income or it could be a net loss, And then dividends always, always, always make the equity go down. So I'll put that in parentheses. I'll put less dividends. Okay, again, fill in what you know and then work on that which we don't know. Owner investments, I'm looking right here at CBS right now. I'll circle what I'm looking at. The beginning of the year was 0. They invested 110,000. We don't know what dividends are. I'm going to put my yellow mark there. And we know that net income was 22,000. And we know that ending equity was 104,000. Okay, here's how I would personally do this. I would focus on the equity changes. In other words, I would look at the beginning and ending equity, just like we did on the last problem. And if I did that, I know that my change to equity is 104,000. And 3 things cause every change in equity. Owner investments make it go up. Net income makes it go up. So I'd be adding these 2 in my head, 132,000. And I know I have to get down to 104,000. So the difference between 132 and 104 would be, let's see, can't really do that in my head, kind of overwhelmed. Let's see what I wrote down. 28. Does Connect have you put that in as a plus or a minus? I'm not sure. I didn't check. I could go look at the answer book, most likely. But sometimes Connect even changes that. A couple of you have tried that, but I don't think I see the person in the room that tried it. So you could answer that for us. If anybody else has tried it and you know how they show it, speak up, please. I'm trying to find it in the answer book to give you some guidance, but the thing is lengthy. And I usually don't have the answer book up because I hate the way they approach the problems. I guess my thinking doesn't always match the way the book thinks about it. They just show dividends as a minus. I don't know if they're going to have you enter that with a plus or minus. You guys will have to let me know. All right, I'll do one more. ABC. Okay, channel 7 at my house. 0 was their starting equity. They didn't give you owner's investments. That's going to be my X or my yellow number. They did tell us that dividends were paid out to the shareholders, which always make equity go down. And they told us that net income was earned. And they told us that we ended with 85,000. So again, the way my brain works is I look at the change in equity again. The change in equity is 85,000 from start to finish. 3 things caused that to happen. The owner's investment, the net income, and the dividends. Well, here's what my brain does, not necessarily what your brain does. My brain sees that the difference between those 2 is 37,000, and I have to get up to 85,000. So the difference between 37,000 and 85,000 is 42,000. That's how I would attempt those exercises. And then make sure this foots. Once you have your answer and you're taking a test, make sure this foots. Make sure that 0 plus 42 plus 90 minus 47. Make sure that does foot. That's another way to double check yourself on the test. That is chapter 2. Lots of old stuff, not a whole lot of new stuff, but the new stuff is significant in that it deals with equity. Equity accounts are new. Equity statement, the statement of retained earnings, that's new. And changes in equity is a revisit from chapter 1, which did give people trouble on the homework. So here's what I want you guys to do. I want you to get the homework done. We've done 100% of the chapter. I really think you guys can blow out this homework in between an hour and 2 hours. I would try and blow it out today or tomorrow if at all possible. And I do know that a lot of you work full time and you can't always, do the homework ahead of time. But I would try and crank it out, get it out of the way, because out of the 3 chapters that are on this first test, chapter 3 is the one that's going to challenge us a little bit more than these first 2 chapters. You guys must have questions after that. Nobody? Okay, so here's what's going to happen. Julie will post her file shortly, and then I'll come behind her and post the answer for the financial statement one where we shortcut it. If there's anything else you guys need the answers to, something that we shortcutted too much, let me know and I'll post that. Otherwise, I think we're good to go. Again, if I go back to my schedule, I'll give you guys another chance to ask questions. If I go back to my schedule that we were looking at, you'll notice that we are talking about chapter 3 next time. So even though that video prep is not due until next weekend, I would encourage you guys, if at all possible, to take a look at it before we come back to class. It'll make the lecture much more meaningful to you. If you don't have any questions, let me come back in the room, make sure that our chats got answered. Julie did post a file in the chat room. You guys can go click on it right now and download it if you want. Anybody have any questions? Anything that threw you for a loop, something you need explained again? For those of you that came into the class, I appreciate you. For those of you that are showing your face, that makes the lecture much more meaningful for me when you can. I get a bad hair day today too. If I had my choice, I'd have the video off, but that doesn't work well in a live Zoom lecture, so I had to keep mine on. You guys that are working at home have the same accessibility to me. I was in my office before class. I will be in my office quite a bit today, not on live Zoom. I don't have my Zoom turned on, but if you need help with something, good chance that I could get back to you via email or via a Zoom. So those of you that have the time, jump in, get that homework done. We were talking about time management. Another student and I were talking about time management. I really do strongly believe that with accounting classes, you have to build time blocks in during the week. And I was telling the student that I look at it as a doctor's appointment. If I make that appointment with myself, I keep it. And if you were at my house, you would see a do not disturb sign out when I'm doing my homework. When I had small children as a single mom, sometimes I had to go in the closet, right? Because I just didn't have that extra room when I had small little ones. So go wherever you can. The school does have a study hall with where you can bring in computers and so forth. I don't know if the library is open for you to come in there anymore. I haven't been able to get a read on that.
It is.
Oh, it is. So you could,
Yeah.
You could go in there and do your homework if you wanted.
Yeah, you can. Yeah.
Okay, good to know. I'm happy to hear that. All right, guys, then I will call it a day. Don't forget the files will be in the discussion link shortly, and I will look forward to hearing from anyone that needs help.
Thank you.
Thank you.
Thank you.
Thanks. Bye.
Thank you, Professor.
You're welcome. Thanks, Julie.